Good day, everyone, and welcome to this recording of an explanation on question 9.3, and it deals with closing transfers for the perpetual and the periodic inventory systems, both of those. In the required part, they ask us to prepare the general ledger accounts, including the trading account, but excluding bank, debtors control, and creditors control, properly balanced or closed off, and the closing transfers in the general journal of low-lac traders for January 20.5 by using in the A part, perpetual inventory system, and in the B part, the periodic inventory system. So the reason why they are excluding bank and debtors and creditors control is because if you think back to the closing process, we're trying to calculate the profit or loss. And profit or loss is calculated by taking all the income items less all the expense items. So they don't want to see the assets and liabilities, bank and asset, debtors control, and asset, creditors control, a liability. They only want to see the influence on the income and expense items. Now, if they ask us to prepare the trading account, including the trading account, in the closing process, we're trying to calculate in the trading account the gross profit. Remember, step 2 in the closing process will be to draw up a profit or loss account, and there we want to calculate the final profit or loss for the entity for the specific financial year. So we're just going to focus on income and expense items to calculate the gross profit using first of all the perpetual and in the second instance the periodic inventory system. The given information, they tell us on the 1st of January, low-lac traders had inventory with a cost of 22,000 Rand on hand. So that's start of the period that we are reporting, 1st of January. Then they give us a number of transactions where we buy and we sell, or we return or we receive returned items. And then in additional information, number 1, they tell us that low-lac traders uses a profit markup of 20% on cost for cash sales. Okay, so markup, we know that we work with cost, profit, and selling price. And whatever they tell you this was calculated on, or if it was a markup, you know that that will be stated as the 100 in our 9-block calculations. So if they tell me that for cash sales, I had a markup of 20% on cost, cost will then be 100, the profit will be 20, and the selling price will be 120% for all cash transactions. But the gross profit percentage on credit sales is 25% on the selling price. So now my basis changes for the credit transactions. So my selling price will now be 100. If the profit is 25, then the cost percentage-wise will be 75%. So we're going to use different gross profit percentages for the cash transactions and for the credit transactions. Good, so I'm not going to revise the calculations, I'm just reminding you of how to deal with these different gross profit percentages. In additional information number 2, they tell us that inventory on hand at 31 January 20.5 amounted to 42,500. So can you see we had the opening inventory at the top there, and now they give us the closing inventory as additional information number 2. So I'm just going to show you for the perpetual inventory system how they accounted for all of these transactions in the general ledger accounts. Can you see that perpetual inventory system is a continuous record keeping of what happens to inventory in the asset account, in the inventory account. So whenever I purchased, I would increase on the debit side. And whenever I sell inventory, it will decrease on the credit side. Whenever a debtor returned goods, I will also have an increase on the debit side. And whenever I return to a creditor, I will have a decrease on the credit side. I would also have corresponding entries in the expense account for cost of sales whenever I sold to either debtors or cash. So can you see we have a cost of sales entry for my sales there, cash sales on the 8th, as well as for my credit sales on the 21st. And then if the sale was returned, I would also have a reversal of the cost of sales on the credit side. So this expense account is linked to sales transactions that I took out of inventory because it's cost of sales, so it's the cost of the inventory sold, cost of sales. In the sales account, I will have my selling prices accounted for, both for cash and credit sales. And if the debtor was not satisfied and he or she returned the goods, I will have that on the debit side in a separate account, debtors allowances. So we keep track of sales returns in a separate account from sales so that if this amount, this 4,000 Rand, increases to an unmanageable value, I would have to investigate that as the sole proprietor. So I do not want to set off the sales returns against the sales initially because I want to keep track. This is for control purposes. I want to keep track of my sales returns in a separate account. Good. So in this perpetual inventory system, can you see that the normal transactions will result in entries in the asset account, in inventory at the top. I will have a cost of sales expense. I will have a sales income item, and I will have a debtors allowances or sales returns, but debtors allowances is the terminology used for perpetual inventory system. So I'll have these entries as a result of my trading activities. Now, if I want to calculate the gross profit in the perpetual inventory system, gross profit is calculated as sales. So there I have a sales account minus my cost of sales. Okay. So if we go to our sales account, I want to now close off the sales account to the trading account. But before I can do that, I want to do that as my closing transfer. Can you see that I had sales returns over here, debtors allowances? So your step one would be to close off the sales returns to the sales account. Now I have my net sales in my sales account. Closing off means you get both sides of the general ledger account to be equal in value. So to close off debtors allowances, I would have to credit the debtors allowances with 4,000 because then I have 4,000 Rand on both sides of this account. So that would be a closing transfer. And for every credit I need a debit, so I will have the 4,000 Rand on the debit side for sales. Now, once I have my net sales, I can go over into step 2. So I want to get the sales account to also add up to 54,000 on both sides. That's closing transfers for income and expenses. So what is the amount that I need on the debit side? I need a 50,000 Rand debit in sales. So this is my step 2. But now for this debit, I need a corresponding credit. so it will end up in the trading account. Let's have a look. In step 1, I took my debtors allowances, so I took this 4,000 Rand over here and I transferred it to the sales account. So I've got a credit in debtors allowances and a debit in sales. And then in step 2, I could now close off my net sales of 50,000 Rand, debit in sales, and a credit in the trading account of 40,000 Rand. Have a look at your trading account at this point. Remember, we're trying to calculate the gross profit. So at this point, my two income and expense accounts, there I have my income, and debtors allowance is the reversal of the sale. So I've got them equal in values on both sides. I close them off, and this whole process for sales will result in the net sales increasing profits on the credit side. Remember, trading account is a calculating account, so I'm trying to calculate the gross profit, which is equity. So sales will end up on the positive side. From my sales account, I took the net sales over to the trading account. The next step in my process, I want to deduct cost of sales from the sales to calculate gross profit. So my cost of sales account at this point has got entries on both sides. I need an entry on the credit side to get this account to balance, to close it off. So I would need 40,000 on the credit side of cost of sales, and for every credit I need a corresponding debit. So it will be closed off cost of sales to the trading account. So at this point, we took the cost of sales to the trading account. We already have our sales in our trading account. Can you see that all the income and all the expense items that I started out with, I've now done the closing transfers for them via the general journal. So in my trading account, I will end up with net sales as an increase in gross profit, cost of sales as a decrease, and then my balancing amount is my gross profit. Where do I take the gross profit? I would transfer that to the credit side as the starting point for my profit or loss account. So I can start off by calculating my profit for this period with a gross profit from the trading account of 10,000 Rand. That is the perpetual inventory system. If we use the same information, opening inventory provided at the start, plus or minus all these transactions, they give me profit margins and they give me the closing inventory again. But now we're going to apply the periodic inventory system. Quick recap of periodic. Can you see that the periodic inventory system, I do not make use of the asset account during the financial period. So I would only have the balance of inventory at the start of the period because I determined that value with a physical stock take. at the end of the previous period. I'm not allowed to touch the inventory account during the financial period. So instead of using inventory as record keeping mechanism, I'm going to use alternative accounts like purchases and purchases returns. I will still keep track of sales and sales returns or debtors allowances. For periodic, we use the terminology sales returns. So if we start our process of closing off these income and expense items to the trading account, I still have a sales and a sales returns account. So I can start by closing off my sales returns to my sales account and then take my net sales to my trading account. So in the trading account, I'm going to end up with a net sales to the same value. Remember, I can just draw the pictures. I had sales and I had a sales returns. So sales returns would have been on the debit side during the normal course of transactions. So to close it off, I would credit the sales returns and debit the sales account. So the sales added up to 54,000 on the credit side, cash and credit. So I want the same value to be on the debit side of sales. So to get the same value, I would have to debit the sales account and corresponding credit in the trading account. Our next item, remember to calculate gross profit, I would take sales minus cost of sales. Now we have a problem because in the periodic inventory system, we did not keep track of cost of sales. So I would have to go into a calculation of cost of sales, which is my opening inventory plus my purchases plus any other expenses related to cost of sales. So these other expenses can be items like freight on purchases or import taxes, without which you could not generate the sales. And from all of this, I will have to deduct the closing inventory to determine in the end what was my cost of sales that I can deduct. So this calculation of cost of sales will have to happen in the trading account. Remember, gross profit is calculated in the trading account. So I'm going to start off by trying to close off opening inventory to the trading account. In your inventory account, you had the 22,000 as the opening balance, and you could not touch the inventory account during the year. So to get rid of that debit, I would credit the inventory account and I have a corresponding debit in the trading account. So in my trading account, I have my increase for sales on the credit side, and now I'm starting to calculate my cost of sales by transferring the opening inventory to the debit side of the trading account. What is the next item that I need? I need my purchases. So in the calculation of my cost of sales, I will have to transfer purchases over to the trading account. But I have an account for purchase returns, which I first will have to close off to the purchases account before I can take the net purchases to the trading account. So purchase returns would have an entry on the credit side. So I had the 3,500 normal transactions on the credit side. How do I get rid of a credit? I will have to debit the purchases returns with a corresponding credit in purchases. In my purchases account, I would have had transactions on the debit side. So to close off the purchases account, I will take all these debits minus the purchase returns, and that will result in a credit entry in purchases of 60,500, which will be closed off to the trading account. So can you see this entry in the general journal is just to reverse the purchase returns back into the purchases account so that I'm left with my net purchases. And then I can close off my net purchases to my trading account. In the trading account, I had the sales as an increase. I'm busy calculating cost of sales, and cost of sales is the opening inventory plus the purchases plus any other expenses if I had any, like freight on purchases or import taxes, which I don't have in this example, but they would also end up on the debit side. In the trading account, I'm trying to calculate the gross profit. Gross profit is sales less cost of sales. In the absence of a cost of sales, I need to go over into calculating cost of sales. The final step to calculate cost of sales was opening inventory plus the purchases plus any other expenses which we do not have minus the closing inventory. Remember, I didn't keep track of what I sold, cost of sales. But if I know what I started out with, opening inventory, plus I know what I added, purchases, minus what I saw with my eyes again, the difference between available for sale and what I have left will give me what I sold. That's why we go into this calculation. Now the closing inventory again, I could only determine that by performing a physical stock take. So I saw this with my eyes, the closing inventory, and the closing inventory in this example was stated as 42,500. So if you counted inventory in your storeroom, that would be a positive in the asset account. So I debit the inventory account with the corresponding credit in the trading account. At this point, our trading account to calculate gross profit is the sales minus, I want to deduct cost of sales, but I go over into a calculation, opening inventory plus purchases. But then from these two amounts, I need to deduct the closing inventory. So can you see closing inventory, which is deducted, is on the opposite side. It also needs to be on the opposite side because in my inventory account, this 42,500 is positive because I counted it with my physical stock take. So sales minus cost of sales equals gross profit, and gross profit will be taken to the profit or loss account. In my income and expenses, I closed off sales returns or debtors allowances. In the periodic, we rather use the term sales returns to my sales before I could take my sales to the trading account. I then transferred the opening inventory to the trading account. So can you see we started off with 22. We transferred the opening inventory to the trading account. So at this point we have 0 in inventory because I have the debit and the credit side equal. Opening inventory plus purchases, but before I can take purchases, I first need to get to net purchases. So I take my purchase returns and close it off to the purchases account before I take my net purchases to the trading account. Opening inventory plus net purchases minus the closing inventory. So the closing inventory is also an entry against the trading account, but can you see that now it's positive in the asset account? So it has to be on the debit side of inventory, resulting in a credit in the trading account. So the trading account, to calculate the gross profit once again, starting off with sales, which is positive, minus cost of sales, which I did not keep track of. So I go over into my calculation, which is step 1, opening inventory, plus step 2, net purchases, plus or minus any expenses, which we didn't have in this example, minus the closing inventory of 42,500. So those 3 steps will get me to cost of sales. So sales minus cost of sales equals gross profit, which is closed off to the profit or loss account, so that I can start off my profit calculation in the profit or loss account with my 10,000 Rand gross profit, which I determined in the trading account. You will recall that for the perpetual inventory system, we also had a gross profit of 10,000 Rand. I trust that you found this informative. Please join us again for another recording.